Federal Reserve Chairman Jerome Powell testified before the House Financial Services Committee on Tuesday, and those comments have huge implications for stock market investors. Of course, the testimony impacts all stock market investors and all stocks because inflation and interest rates impact every single business in the United States and worldwide. So, this is something that every single stock market investor needs to know about. I'm going to highlight the details of what was said, the big takeaways, and what it could mean for inflation and interest rates.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Chairman Powell declined to comment specifically on the potential for cutting interest rates at the Fed's next meeting in July. He reiterated that he wants to get more information before he makes a decision about cutting interest rates. But I'm going to share with you that the next move is likely an interest rate cut. When the Fed does decide to make that move, it's likely to be an interest rate cut and not an interest rate increase. And I'm going to share with you the data on why I think that's the case in just a little bit. The Fed chief also indicated that June and July inflation figures will be particularly important because now is the time when higher import duties ought to be showing up. And the higher import duties, of course, is a result of President Donald Trump's increases in tariffs on all of the United States trading partners, and in most particularly against China and the huge increases in the tariffs against China. Many of the biggest U.S. businesses, including Walmart, Target, Nvidia, AMD, and others are importing significant percentages of their products from China. I forgot to mention Amazon. And so with the higher cost of goods to import those products from China, it's going to result in increasing inflation in the United States because these businesses, they cannot absorb all of those higher tariffs, right? The tariffs on China in some products are over 55%. So if you were a business and you were paying a certain price for your products from China, now you're going to have to pay 55% more. And so with that increase, your business is likely not to be profitable if you absorb all of that higher tariff. So what you're likely to do is ask your supplier to absorb some of that tariff, and you're also likely to increase prices that you charge your customers so that you mitigate those impacts from tariffs. Of course, as a business, you're also concerned that if you raise prices too much, your customers are not going to buy your products anymore and your customers are going to pull back their purchases. It's not so much a concern that your customers are going to go to a rival or go to a competitor because nearly every competitor is facing those higher tariffs. But what's more likely to happen is consumers are likely to pull back their purchases on goods and more likely to spend money on services, on digital products that are not facing those higher costs. Because comparatively speaking, as a consumer, when you're thinking about buying a new phone or buying a new TV or buying a new couch, the price is going to be much higher. And then you're going to compare that with spending money on getting more haircuts, visiting the salon more often, buying movies or renting movies online, subscribing to Netflix or other digital products. And comparatively, you're going to say it's such a better deal to just use our money to subscribe to Netflix than to use our money to buy a new couch or use our money to get, more services than to spend money or go to a concert or something in that nature that's not impacted from tariffs. So Powell swatted away questions about tax and immigration policy, which have huge implications for inflation and interest rates. Of course, he reiterated that the U.S. is on an unsustainable path for borrowing. We have over $35 trillion in debt, and the shift in immigration policy has reduced growth in the U.S. labor force. Of course, if you're deporting immigrants and you're not accepting new immigrants, the labor force is not increasing, it's decreasing, and that's slower growth for the economy. Housing was another popular topic, and at least one thing that's been good about the housing is that the price growth has slowed down. Still, housing remains extremely expensive and unaffordable for purchase for many individuals. Lower interest rates will help the affordability of housing. So I mentioned that the central bank of the United States, the Federal Reserve, they focus on two things, right? Inflation and unemployment. And the unemployment rate, even though it's been rising, is still at historically low levels. What I have here is a chart from the Federal Reserve Bank of St. Louis, fred.stlouis.gov, if you want to see the same chart. And you can see our unemployment rate right now is around 4.2%. And that's at historically lower levels going all the way back to 1950. All right. But the bad news is that the unemployment rate has been rising. You can see that steady increase here in recent months. The unemployment rate is increasing. And if you look back at this chart, and if you look back at unemployment historically, when the unemployment rate starts to increase, it usually continues to increase until the US economy goes into a recession. And then the central bank reacts by lowering interest rates. And then the federal government reacts by taking into account the recession and enacting stimulative policies to try and boost the economy. So right now we're in the beginning stages of the unemployment rate increasing, and more details have come out that the labor market is getting softer. Businesses are not firing people, but they are slowing hiring. They're keeping existing people and they're hiring fewer new people. So when a business sees a vacancy or when somebody quits, they're not replacing that worker. They're just keeping employment the way it is and keeping people that they like, keeping people that they have, and they're just trying to see where this economy goes because there's a lot of uncertainty. There's a lot of question marks with how the US consumer is going to respond to higher tariffs, right? And the impacts of tariffs, we still haven't felt them just yet. It's still in the very early stages. Most of the products you're seeing on store shelves today have been imported months ago. So those businesses and those products didn't face the higher tariffs. What you're going to start to see as through the end of the summer and through the end of this year is the products that are coming in now that are starting to face those higher tariffs. So you're going to start to see those higher prices in stores. If you followed my videos on companies like Walmart, Amazon, Target, Costco, and others, they all stated that they will be increasing prices, but they haven't started increasing prices just yet. But they did warn investors and they did warn consumers that they will be raising prices because of tariffs. And so you're going to start to see that. And when you start to see that, that's when we'll know how the US consumer is going to respond and what situation the US economy is in. So what I pulled up here is the chart for US inflation going also all the way back to 1950. And you can see that inflation was for the most part under control all the way up to 2020. And the impact following the coronavirus pandemic was to create a huge surge in inflation. Policymakers, I don't know what they were thinking, but in the middle of a supply shock, they also sent people trillions of dollars in stimulus. So you had a situation where businesses were unable to make things at the level that they're used to making them because the government forced them to shut down or forced them to have smaller operations. And at the same time that they forced businesses to stop producing as much as usual, they sent out trillions of dollars to consumers. So you had more money in consumer pockets and you had less things to buy. And of course, that created a surge in inflation, which, if you asked any economist, what they would have told you this would have happened given those choices, given those situations. But I still wouldn't just go and say that that was a bad decision by policymakers. That was something that they were willing to tolerate. Policymakers were in a tough situation during the pandemic and they had bad decisions. Any decision they make was going to be a bad decision, and they chose to make the decision with the least likely disaster scenario. And so rather than risking a scenario where consumer spending collapses, they'd rather risk that chose to risk the scenario where inflation gets out of control, which is what happened. Inflation got out of control. And so, in response to that, the central bank, Jerome Powell, significantly increased interest rates from 0 all the way up to 5% very quickly. And that created a situation where inflation started to come under control, right? You had inflation crash all the way down, and inflation is now closer to the central bank's target of 2%. It's at 2.767%. So it was coming down and approaching that target level. But this is now before the impacts of inflation. The impacts of tariffs. The impacts of tariffs threaten this good news on inflation because they could cause inflation to get out of control again, which then the central bank would need to raise interest rates to get inflation under control. So that's what Jerome Powell is afraid of. That's why Jerome Powell has resisted cutting interest rates, even though President Donald Trump keeps pressing Jerome Powell to cut interest rates. The chairman, knowing this history of inflation, knowing that we're at risk of having inflation get out of control again, is waiting to get more data before cutting interest rates. So I don't think inflation is going to get out of control again. I think inflation will moderately increase as a result of tariffs, but then will continue moving down because one of the main components of inflation is oil, and oil prices have been coming down, especially after the Iran-Israel ceasefire deal. Oil prices have been coming down, and then investors have seen that the economy will grow slower as a result of the policies of President Donald Trump. So these slower growth prospects means lower demand for oil, means lower prices for oil, and oil is an input for so many things in our economy. And with oil prices lower, inflation is likely to remain lower. So I do believe that the Federal Reserve, their next move will be an interest rate cut, not an interest rate increase. But I don't think that interest rate cut will come at the next meeting, which is going to be held in next month. I think the interest rate cut may come later in the year as the U.S. economy slows down because of the higher cost of goods and the slower hiring. And then as the economy slows down, you'll see inflation slow down. And then the central bank will have a comfortable position where they can cut interest rate without risking an increase in inflation again. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.